Okay, so here we are. Let's look at some liabilities, some additional liabilities. We're going to look at liabilities related to vacation pay. And then we're also going to look at company liabilities related to pensions. And this is going to be a pretty brief examination, so this is not going to cover nearly all of what we could cover, but we're going to keep this video fairly basic. So it looks like we have some questions. If you're in one of my classes, it will be Chapter 10, slides 22 through 29 in PowerPoint presentation. Our question here says, the journal entry a company uses to record accrued vacation privileges for employees at the end of the year is, okay, so we remember we are using the we are talking about the accrual basis of accounting, okay? So what that means is when we recognize that we have a legitimate expense, we book that expense immediately. Whether or not we've paid any cash funds or not is irrelevant. So we need to be looking for a debit to an expense account. And anytime we accrue something, what do we accrue? We accrue revenue, but we can also accrue liabilities. Here we're going to be accruing a liability. And so when we accrue a liability, we need to set up some type of payable. So if we look at our choices, choice A looks pretty good to me. It says we're going to have a debit to vacation pay expense. That's true. We will for the full amount. And we will also have a credit to vacation pay payable. Okay, so that is going to be our correct answer. If we look over here, we would never, in the accrual process, we would never debit vacation pay. Let's see here. We haven't paid anything, so we can't credit cash, so C is wrong. And then let's look at D. Let's see here. Well, with D, we have a payable, but we're getting ahead of ourselves. We have to set up the vacation pay payable. And then later on, you know, when an employee takes the vacation, we can then debit the vacation pay payable and then credit salaries payable, because we still haven't paid them yet. But for our purposes, based on our question, choice A is the correct answer. Okay. It says vacation pay payable is reported on the balance sheet as a, so we need to be looking for a choice that has the word liability in it. Choice A, B, and D does. Choice C is an expense item, and expenses are over on the income statement. Liabilities are on the balance sheet, so we can immediately eliminate choice C. That's impossible. So let's see what it says here about choice A. It says current liability or a long-term liability, depending upon when the vacations will be taken by employees. And this is a very important point here. We're going to accrue the liability and take the expense immediately. But if a company has a sound reason to believe, let's say that they take vacation expense of $200,000, but they believe legitimately that $150,000 of that will be taken in the next year, and then $50,000 after that, it would be appropriate to present that on the balance sheet as a current liability of $150,000 in that example, and a long-term liability of $50,000. Of course, if they anticipate that all of that's going to be taken in the next year, then it would be as a current liability. But choice A is actually the correct answer here. All right, let's flip the page and see what else we have that we can learn. Okay, and let's see here what we have. Move that down. I don't think we're going to need our calculator. I can get rid of it. Okay, so it says during its first year of operations, the company granted employees vacation privileges and pension rights estimated at a cost of $21,500 and $15,000. So $21,500 for the vacation privileges and pension rights of $15,000. The vacations are expected to be taken in the next year, and the pension rights are expected to be paid in the future 5 to 30 years. What is the total cost of vacation pay and pension rights to be recognized in this first year? Well, the fact that we are taking, they're not really being very specific here with this question. We are going to set a liability, or we're going to expense the vacation and pension. We're not sure what they want us to do. Let's see here. So what is the total cost? What is the total cost? Well, total cost is $21,500 for the vacation privileges and $15,000 for the pension benefits. It does not matter actually when the vacations are taken in this case. The fact that they're going to be taken in the next year is relevant to where they're presented on the balance sheet as a current liability or a long-term liability or a combination of the two. But the cost is $21,500, and the cost for the pension obligation is also to be recognized in full. That's $15,000. If we do some simple addition, we can see that the answer to this question is $36,500. More questions and we'll stop this video. It says, a pension plan that requires the employer to make annual pension contributions with no promise to employees regarding future pension payments is termed. So funded, unfunded, defined benefit, and defined contribution. Well, what we said about defined contribution pension plans is that what we ask ourselves this question: what is defined? I guess we could do this a different way. Let's put the question mark over here and do it like this. What is defined? Well, in this case, what is defined is the contribution. Okay? So our answer is going to be a defined contribution plan. The employer is saying, I'm going to define the amount of the contribution with no promise how much pension you're actually to get. Why? Because it's based essentially on the stock. What are the returns on these contributions that the employer makes on the employee's behalf? Last question says, a pension plan that promises employees a fixed annual pension benefit based on years of service and compensation is called a, says, promises employees a annual pension benefit. So what is defined? It is the benefit in this case that is defined, and therefore our answer, let's see here, is a defined benefit plan. Just as with the previous example, the employer is going to make a contribution on the employee's behalf. However, the employer is defining the benefit, and if the returns on those investments that the employer makes do not equal the fixed annual benefit that is promised, well, the employer has to kick in extra funds to make that happen. So if we had to have a choice between which one of these two that we wanted, we're going to want the defined benefit plan if we're an employee. If we're an employer, we're probably going to want the defined contribution plan. Not much of a liability. As soon as we pay it, the liability goes away. Defined benefit, these suckers last for a very long time. All right, let's end this video and we'll pick up with another one shortly.